You've probably seen the ads. 9% yields on dividend ETFs. Do the math. $100,000 invested? That's $9,000 a year. $750 every single month. Free money, right? Wrong. And I'm going to show you exactly why, with real numbers that nobody talks about. Before we get there, here's what's actually happening right now in late 2024. JEPI, that's JP Morgan Equity Premium Income, is yielding 9.2% annually. QYLD is even higher at 11.6%. Meanwhile, your high-yield savings account is sitting at around 5% if you're with Marcus or Allie. Treasuries are paying 3.8 to 4.2%. On the surface, dividend ETFs crush everything else, but the surface is where most investors stop looking. Let's start with the actual monthly income you'd receive. This matters because numbers feel real when they're in your checking account. Take $10,000. At a 9% dividend ETF, you're looking at $900 per year. That's $75 in your account every month. A high-yield savings account at 5% gives you $500 per year, or $42 monthly. Already, you're ahead by $33 every month. But here's the catch nobody mentions. Let's scale up to where real money starts mattering. Now imagine $50,000. The dividend ETF throws off $4,500 annually, $375 monthly. A 10-year Treasury at 4% yield gives you roughly $2,000 per year, or $167 a month. You're now $208 ahead every month. That's starting to sound like lunch money. For some people, that changes the equation. But keep scaling. Here's where the promise gets real. $100,000 invested in that 9% dividend ETF, $9,000 per year, $750 per month. That's a car payment. That's groceries for a family. That's meaningful. A Treasury bond at 4% only pays you $4,000 yearly, or $333 monthly. The gap is $417 per month in the dividend ETF's favor. But here's where I need to be honest with you, because this is where the YouTube finance crowd gets vague and hand-wavy. That $9,000 isn't actually $9,000 hitting your account. ETFs like JEPI, XYLD, and QYLD don't distribute qualified dividends. They distribute short-term capital gains. That means the IRS taxes them at your ordinary income tax rate. If you're in the 24% federal bracket, and most people in this income range are, you're paying $2,160 in federal taxes alone on that $9,000. Before state taxes, before anything else. Your $750 monthly becomes $570. Just like that, $180 evaporates. Here's what makes this worse. The HYSA interest is also taxed as ordinary income, but people hate that fact so much they just ignore it. Don't be that person. If you're earning 5% on $100,000 in savings, that's $5,000 taxed at your ordinary rate. After 24% tax, you're taking home $3,800. But the volatility is zero. You can't lose principal. The dividend ETF, after taxes, nets you $6,840. You're still ahead by $3,000 per year. Except, that's where we hit the trap almost nobody discusses. Price depreciation. JEPI hit $67.50 back in June 2022. By March 2023, it had crashed to $51.32. That's a 24% capital loss while you're collecting your 9% dividend. Even after the dividend and the price recovery to around $57.58 now, many people who bought at the peak still underwater. The 9% yield was real, but you lost 10% of your principal just holding the thing. Here's a real scenario. You invest $100,000 in JEPI at $60 per share. You receive $9,000 in dividends that year. Congratulations, you've hit your $750 monthly target. But the price drops to $54 per share. You've lost $6,000 in principal. Net result? You're up $3,000 for the year, not $9,000. Suddenly, that dividend doesn't look so amazing. QYLD has the same problem, except it's actually baked into the strategy. Covered call ETFs cap your upside. The yield is higher, 11.6%. Specifically because you're sacrificing gains. If the NASDAQ explodes 20% in a year, you're capped at maybe 10% because your shares were called away. You got paid for that restriction through the high dividend. On a bull market year, that's an awful trade. On a bear market year, you're grateful. There's another cost people skip over: expense ratios. JEPI charges 0.35% annually. On $100,000, that's $350 per year, or roughly $29 monthly. QYLD costs you 0.60%, which is $600 yearly. Treasuries and savings accounts have effectively zero expense ratios. It's small, but it compounds. Here's where it gets interesting, though. The Federal Reserve just cut rates by 100 basis points from July through December 2024. If that continues into 2025, and current expectations suggest rates could drop to 3.5% to 4.5%, your HYSA is about to become significantly less attractive. Those 5% rates you're seeing today, they're probably gone by mid-2025. You'll be looking at 3.5% if you're lucky. Dividend ETFs? They're less affected. The yields are equity-based, not rate-based. When rates fall, dividend stocks often appreciate because they become more valuable relative to bonds. Your JEPI yield might stay sticky around 8% to 9%, even if the Fed cuts aggressively. So here's the actual verdict, and it's more nuanced than clickbait allows. If you need income today and you're willing to accept 12% to 14% annual volatility, that's what GPI experiences, and you can handle seeing your $100,000 swing to $87,000 and back to $105,000 without panic selling, the Dividend ETF wins. You're getting roughly $500 more per month than a savings account after taxes. Over 5 years, that's $30,000. That matters. But if the Fed starts cutting rates hard and HYSA yields drop to 3.5%, that math shifts again. A $100,000 HYSA earning 3.5% nets you $2,660 after 24% tax. The Dividend ETF at 9% nets you $6,840. Now the gap is $4,180 per year. The volatility trade starts looking really good. However, and this is capital letters, however, you cannot ignore the depreciation risk. Buy JEPI today, it drops 15% this year, your total return is negative despite the dividend. That can happen. It has happened. Treasury bonds don't do that. Savings accounts don't do that. You trade safety for yield. So the honest answer? It depends on 3 things. 1. Can you tolerate seeing your balance drop 10 to 15% without selling in a panic? 2. Is your time horizon at least 3? 5 years? 3. Are you comfortable with a 24% tax bill on that income? If you answered yes to all 3, dividend ETFs make sense above savings accounts today. Below 3 years, or if volatility terrifies you, stick with savings. Between savings and treasuries? Treasuries win if you can't sleep at night with stock volatility. They win by a smaller margin after taxes, but you win at not doing something stupid. The thing nobody tells you is that none of these choices are wrong. They're just different risk-reward trade-offs. The mistake is pretending $750 monthly is guaranteed. It's not. It's a yield on a volatile asset with a hefty tax bill. Now you know the actual numbers. What you do with them is up to you. If this helped you stop chasing the dividend dream and start building actual wealth, hit that subscribe button. And in the comments, tell me, are you team dividend ETF or team boring high-yield savings? I want to hear what your actual situation is. We'll see you next week with the strategies that actually move the needle.